Good afternoon, everyone. Welcome to Coffee with Carl. I have the pleasure of having Deron McCoy, our Chief Investment Officer with Signature Estate and Investment Advisors. Welcome, Deron.
Hello, hello. Well, thanks for having me.
Yeah, appreciate you joining. So this afternoon, I want to spend some time just getting your guys' pulse on where you guys see the market. I know it's been a very challenging year, certainly for a lot of folks when they open up their 401k statement or their investment statement. It's been a bit of a sticker shock. So if you wouldn't mind, just give us your guys' take on, where we are now and, where you guys see this market going over the coming months.
Right. I think the big takeaway is that investment landscapes change. And so I think humans always try to take today's events and extrapolate them forever into the future. But from our seat, investments change because the landscape changes. And I'll give you a couple of examples and we can talk about what we think might happen next year. It was July of 2021, so a year and a half ago, we were talking about, were we going to get back to normal after COVID, or were we heading down this other path of the economy was over-caffeinated, overstimulated. There was too much money in the system. There was too much froth. And so when we started thinking about it that way, you start seeing inflation come through the system. And then when that starts to happen, when Dogecoin and all these meme stocks are going to the moon, there's just too much money in the system. There's too much froth, which leads to too much inflation. And then inflation just changes everything. It changes the landscape. So when you have 40-year highs in inflation, you have interest rates that have to go higher. And when you have a Fed that's behind the curve, they basically took all of 2021 off. They're kind of catching back up on all their work that they missed out on. So that leads to the fastest rate hiking cycle in 40 years. And so that's 2021. High inflation, a Fed behind the curve causes these rates to move higher very quickly, 75 basis points every meeting. That changes the landscape for investments. And so that's what we're kind of in right now. And then really June of this year, we were talking about, you had a historic sell-off in global bond markets. You had a historic sell-off in global stock markets because of this inflation, because of this higher interest rates. So it felt kind of like a hurricane. Yep. And then you had a couple of analysts back in New York saying, well, you know what? There's another hurricane coming in the economy. And so this higher interest rates, obviously it leads to lower home prices and lower home activity, housing activity. But that kind of then bleeds through the rest of the economy, which there's a slowdown coming. Is it going to be a recession? That's still unknown, but in a weird way, that's a good thing for the long run because a slowdown in the economy, recession brings down demand. Then it kind of can match back up with supply. And that's Econ 101, demand. When demand and supply are equal, prices are stable and prices are inflation. And so we can bring back down inflation and we can get back to a normal type of business cycle. What we don't want is multi-year period of high inflation like we saw in the 70s. So that's where we've been the last 12 months. Potentially we get a slowdown in the economy this next year, but I don't think this Coffee with Carl is for corporate CEOs. For the most part, it's probably for investors, right? And so we have to have our frame of mind on the investor lens, not a corporate CEO lens. So if we were talking to a corporate CEO, we might say, yeah, we need to brace for an economic hurricane is what JP Morgan, Jamie Dimon called it. But we're not, we're talking to investors. And so we need to realize and be cognizant of the fact that Wall Street, stocks and bonds doesn't necessarily equal Main Street. So the pain on Wall Street that we see this year doesn't necessarily correspond with the pain on Main Street that we might see next year. And we only need to go back to the last crisis, 2008, to kind of see that play out. You had stocks, going crazy in 2008. Everyone knows what happened, but maybe not the sequence of events. So in 2008, you had Bear Stearns and Lehman Brothers and Washington Mutual and all these bankruptcies, AIG, really led to a turmoil in stocks. That was 2008. Ultimately, they bottomed March of 2009. And then we were talking about green shoots and stocks rallied. Meanwhile, the pain on Main Street was coming down the pike. We were going we're based in Los Angeles. The stock market closes at 1 p.m. So we kind of go to lunch afterwards. And during all this mayhem in the market, we would go to the local mall or local restaurant, and people were shopping and people were eating and people were having a great time. And we're like, don't they realize what's going on? It's kind of crazy out there. The pain on Wall Street hadn't hit the pain on Main Street yet. Then fast forward to 2010, 2011, 2012, you had higher unemployment, you had lower home prices, but stocks were up 100 or 200%. So Wall Street was feeling good, but then you went back to that mall for lunch and then there was no activity. The mall was empty. So that's kind of what we see happening this next year is the pain on Wall Street, the hurricane sell-offs being this year, but maybe some pain on Main Street with lower home prices and the slowdown in the economy next year. So that's kind of what we're seeing this play out, kind of as a repeat to the 2008 to 2012 type of time frame.
I think the big thing we're hearing a lot too is about some of the earnings all coming down and projections on that front. How do you guys pull that back in as far as projecting where the market's going to go, and then thinking about the fact that inflation is coming down? So how do you guys juggle the two?
For sure. So we were talking about this hurricane season back in June, a couple of hurricanes potentially going away, that being the sell-off in the bond and the stock market, but then maybe a hurricane coming on the horizon with the economy. So we kind of need to start thinking about what's changed since June. Well, back then, projections for corporate earnings in 2023 hadn't moved. So the expectations for 2023 earnings were still high. And so that has now come down quite a bit. It's off maybe 10% or so. And so while that sounds bearish, the projections for corporate earnings are lower. That sounds like a bearish thing, but stocks kind of trade on expectations. So meanwhile, stocks have kind of hung in there since June. So this new bearish news has come with lower earnings projections. Meanwhile, stocks have kind of hung in there. Is kind of a tell. When they hang in there despite bad news, it might mean that it's all priced in. So corporate earnings projections are lower, but that means the expectations are lower, which means the bar has been lowered, so it can be more easily beat. What else has changed? Interest rates are materially higher. I think in March, expectation for interest rates were 2%, and in June maybe they were mid threes, and now they're over 5. Jerome Powell said the terminal rate, where short-term rates need to go, needs to be higher, needs to be above 5. And so that's bearish too. The rise in interest rate expectations has moved up. Meanwhile, stocks have kind of hung in there. So the expectations is more appropriately set. And then the last thing, we just saw it last week, we're finally starting to see the rate hiking cycle start to have an effect. We started to finally see inflation roll over just a tad. Now, people might say, but inflation is still high. And yeah, that is true. But inflation is a year over year number. So it's just math. So this last inflation print came with a 0.3% month over month number. When you add the whole 12 months previous, it comes up to the high 7s. But it's just math. If we continue to have a 0.3% month over month number, we have a low month in December come in, but a high month of December of 2021 roll off. So automatically the inflation rate rolls down into a 6% number, then a 5% number. And then now we're at a pace where interest rates from Jerome Powell are above what inflation is. And so the long-winded answer is then finally we can kind of end this rate hiking cycle, which has caused so much angst in stock and bond markets. And so the market is reacting to that. They can see the light at the end of the tunnel. And so that's kind of my point. What I first mentioned is the landscape will change. It always has, it always will. So the landscape next year, we can start to see the light at the end of the tunnel. Q1, Q2, inflation might be down to 5%, which means the rate hiking cycle can not only stop or slow, it can stop and then maybe reverse a little bit. That might be premature just now, but but it's this changing landscape. Just think about it. The Fed's not going to raise rates another 4 percentage points next year. So the landscape is automatically going to change, which means the investments will change. So it looks like a better year next year than this year, even into the teeth of a potential recession.
So as an asset allocator, I know obviously this year's been very tough. How have you guys tried to position the portfolios, whether it be defensive towards certain sectors? How do you guys think about, about that positioning for, more currently? And then as interest rates start to come down, really, when do you make that judgment call? Hey, now it's time to, move a little more towards the tech space, or maybe some of the beaten down names, because, we've seen a pretty good rally over the last month for some of those type of strategies. So how do you guys think about that and, positioning?
Right. Well, let's take the easy one first, and that's fixed income. That's bonds. If we think inflation has peaked, if we think a slowdown in the economy is coming, that probably suggests that longer term interest rates are near a top, if not peaked. And so really since December of 2020, we thought interest rates would be rising. So we were trying to play a little bit of defense on fixed income, but actually by not having fixed income, we didn't want a fixed coupon in a rising rate environment. We want an unfixed income or a floating rate income, so we can just make more income as yields move higher. We're starting to unwind that now. This last couple of months, we're starting to add back fixed income, fixed coupons, lock in these higher yields. In bond parlance, it's called duration. Add a little bit of duration to the portfolio. It's the opposite of your home mortgage, right? You want to lock in when rates are low on your loan, on your mortgage, but that's because you're a borrower. As an investor, you want to lock in when rates are high. So on the fixed income side, we're starting to add back duration and moving from an unfixed to a fixed portfolio on the fixed income. In stocks, it's a little bit trickier. I outlined a scenario where lower inflation would help the consumer, which kind of leads to that probably will help consumer discretionary stocks. You'll have a little bit more money to go to on a trip in Expedia or Marriott or go to Macy's or those types of stocks. But if unemployment starts to ratchet up, then you'll have less income out there, not more income out there. So that's still a TBD. We're looking at that and seeing how this plays out. We've had 1 month of lower inflation. We need to see that really become a trend and really see if the weakness in the economy really starts to pick up.
Yeah, what are the biggest things you guys are focusing on when looking at the some of the inflation prints? I mean, are you guys looking at the movement in housing, unemployment? What are some of the key indicators you guys are trying to track to stay ahead of it?
Yeah, a great question. There's what's called hard data and soft data. The hard data is what everyone looks at, what gets posted every month. And we've been saying for a while, because the Fed took 2021 off, they kind of lacked a lot of credibility. They lost confidence in the market. So we've been believing here this year that they needed cover in order to start to ratchet down their interest rate hikes. They needed cover from the hard data, and the hard data just wasn't rolling over yet. But if you look at other metrics called the soft data, it suggested that inflation had already peaked. And so that could be used auto prices have come off. You could look at rents from Zillow. They're coming off their frothy peak. And so that's a different metric than what the Fed looks at. It's called owner's equivalent rent. That hasn't peaked yet, but they're related and they're correlated, but with a lag. So if you start looking at the soft data, you can make an educated decision that probably core CPI and CPI, consumer price index, probably peaked this year and will roll over. And then that's kind of playing out in the market. And one more thing, back to your earlier question, when you're looking at inflation changes everything. It changes the landscape to the upside and to the downside. So if we think inflation has peaked, that probably means the rate hiking cycle hasn't peaked, but the expectations for it has probably peaked. If that is true, then the strength in the US dollar is probably peaked or getting pretty close. Currencies kind of trade on interest rate differentials. And so if the dollar has peaked, we can then go as investors, take our strong US dollar currency and go travel to Europe. The euro's at one parity. It used to be at 140, right? The British pound is getting down there, and it used to be over 2. We can go to Japan. The yen is through the floor. So we can go have a great vacation. But as investors, we can also just go buy assets overseas denominated in those currencies, stocks, right? And so when our dollar starts to depreciate, those foreign currencies start to appreciate. So if we can buy a stock denominated in yen or denominated in the euro or denominated in the pound, if the company doesn't do anything, it's going to appreciate because the currency appreciates. And oh, by the way, valuations overseas are back to 2008 levels, partly because of what's going on in Russia and Ukraine, but partly because the kind of add-on effects from an energy crisis. So if we get earnings momentum, maybe from a ceasefire, I can't predict that, but if and when that happens, you get a kind of a reopening type of trade, a post-war boom. You get earnings moving higher, you get valuations moving higher, and oh, by the way, it's in the currency that's appreciating. So you can play the change in landscape here in the U.S., but you can also play it overseas. International stocks look pretty darn attractive right now.
Where more specifically, you think you guys over allocating towards emerging markets, or what portions of international markets do you really like right now?
We have a kind of a benchmark weighting to both developed markets, basically Europe and Japan, and then emerging markets as well. We are waiting to get a catalyst. Like maybe we didn't get good news today from Russia and NATO, but potentially when we get that catalyst, I think we would overweight developed markets at this point. And then, China and emerging markets is kind of a wait and see there.
Are you starting to see some, it looks like there's some positive developments with China slowing down their zero COVID period timeframe. How do you guys think about investing in China? I know it's been kind of a landmine over the last year, and just emerging market in general.
Yeah, it has. And when they adhere to a zero COVID policy, they really locked down their economy on really just a handful of COVID cases. We would kind of think that is almost laughable, but that's what zero COVID is over there. So when you have a couple of cases, they really shut down the economy. And then that just leads to less manufacturing, less global trade, and less activity in general, which has really put a hurt on their economy and then ultimately on their stocks. We think that may be changing. Maybe not now, maybe after this kind of winter surge, because Beijing is having quite a surge right now in cases. But President Xi's kind of passed his reappointment on another 5 years. And so he doesn't really need to have the the Chinese society be COVID free. Perhaps they kind of morph into a more economic friendly versus a healthcare friendly type of environment. And if that's true, the economy can get going and stocks can get going. But that's just COVID. If you think the other way, China is stimulating their economy, and you can't say that about any other country in the world right now. Everyone else is tightening their belts, and China's trying to stimulate. So it's not something we want to overweight yet, but they're still a big part of the global marketplace, and you kind of have to have, a toe in the water over there.
One question I often get is, when a lot of people have been very concerned about the market, the big pullback, in the last quarter or last year. What are some things that still concern you about the market that could really send this, back the other way, even in the face of this little rally we've seen?
Well, again, inflation changes everything. If we're wrong and inflation stays persistently high, the Fed will continue to have to fight inflation, and that's their mandate. It's not their mandate. It's not the stock market. Their mandate is stable prices, inflation. And so if that is indeed the fact in the landscape next year, then the landscape won't change. It'll be like this one is again. So we don't think that's the case. We're seeing it in the hard data, and now the soft data, and now the hard data, that the Fed's getting this under control. But you can look at other things too. Supply chains. We've been talking about supply chain problems. We've been talking about demand, right? With recession in the economy. But if you look at supply and supply chains, they're improving. So if you can bring down demand a little bit and bring up supply a little bit, again, Econ 101 says inflation should be under control. Obviously, an escalation of the Russia conflict would be not favorable for risk assets, stocks. That's pretty hard to frame in your financial plan. So that's kind of more of an individual choice. We can't really do that from our seat as portfolio managers. What else? Obviously a change in the pandemic, but that doesn't seem to be at cards. And so there's some black swans out there. There's always something to worry about. But if you kind of gather all of these tidbits and kind of read the tea leaves, it looks like a better year next year than this year.
So for folks thinking about just specific U.S. allocations, what segments of the market do you guys like the most? From an allocation?
That's a great question, and I get that question a lot, and I kind of reply with, well, let's talk about what we don't like. So let's talk about what we should avoid. And so going into this year, inflation at 40-year highs, I don't think there's going to be a lot of demand for a new Coach bag, right? Or some discretionary item that people are just trying to go month to month. They don't have a lot of discretionary money in their pocketbook. So we've avoided a lot of those type of retail names this last year. Mm-hmm. But if that rolls over, maybe we look to add to some of those this next year. So I'll give you kind of a quick example there. Earlier in the year, interest rates were moving higher. When interest rates move higher, any part of the economy that's tied to a loan starts to slow down. So obviously that's mortgages. So we wouldn't want to have, a big mortgage provider. We wouldn't want to own that type of name in this type of environment. But people also kind of redo their home, buy new furniture, paint the walls when they move. They don't necessarily, they do some when they're living there for 5-10 years, but you really kind of need a thorn in the backside to get you going. And when you move is when you fix up your home. So we sold Lowe's. We had a big position in Lowe's, which is the Home Depot kind of competitor, thinking that the boom during COVID of everyone fixing up their home and moving and moving to the suburbs, not only will that might slow, but it might reverse if rates get to a point where people aren't moving at all. So that's a retailer that faced a lot of headwinds with higher interest rates. It wasn't good for their investment landscape, but we replaced it with something that would benefit. So I talked about used cars before. If there's no supply chain and you can't get a new car and used car prices are at all-time highs, well, then what might you do? Well, you might fix up your own car. You might do a little work on it. And so we sold Lowe's that had a headwind and we bought O'Reilly Automotive that had a tailwind. So that's kind of an example of how you can reposition assets. They're both in consumer discretionary. They're both US large cap stocks, but one has a headwind, one has a tailwind in this sort of environment.
I guess one question I get to is oftentimes maybe the energy sector. It's had such a strong year. How do you guys think about that space moving forward? And obviously that's going to have a big impact on inflation and some of those inputs as well.
Right. The great stat, I think it's still true, is that Apple, the company, is bigger than the entire energy sector. So at some point, that needs to maybe change here a bit. I think the energy sector is 2-4% of the S&P 500, where Apple is higher than that. Back in the 80s, energy used to be 30%. So I don't think it's going to go there, but can it move to a 10% weighting? It kind of makes sense. So I definitely don't think it's over-owned right here at 3-4% of the marketplace. And then you have the conflict overseas, and then you have the president refilling the SPR. And so there's kind of a bid under energy prices. energy prices should stay high. So energy stocks should continue to do well. The one caveat there is if the recession is a little bit more severe than anticipated, there's going to be less demand for oil. But the counterpoint to that is if China ends zero COVID, there's going to be more demand for oil. So there's a lot of moving parts there. But certainly 5 percentage points of the equity portfolio in energy kind of makes sense right here.
And then as we finish up, what about the alternative space? How are you guys thinking about just hedging strategies or real estate? How do you guys think about inclusion from an asset allocation standpoint? And then just the prospects of those areas, even whether it's a commodity trade, gold, et cetera.
Right.
So what are you guys thinking about in that space?
That's a very client-specific personal decision for each investor, because in some cases, it means that you move from a daily liquid investment like a stock, you can sell it, you can buy it today, sell it tomorrow, into something that might have, you need to hold it for 1, 3, 5, 7 years, something like that in terms of a lockup period, where you have to lock up the capital. Like private equity has a long runway, right? So the investor needs to be comfortable with giving up some liquidity. They can't sell it tomorrow.
Yep.
But I would argue that you probably don't need 100% of your portfolio to be liquid tomorrow. So you can probably take some portion of it and start engaging in these private equity, private debt, private real estate type of arrangements. And then I'll also add that liquidity for an investor usually hurts them. Yeah. They don't normally sell their stocks on January 1st of this year. A lot of retail investors sell their stocks when they're down 25%. So liquidity can actually hurt you, and most oftentimes does hurt the investor. So I think, taking a portion of the portfolio that you don't need tomorrow, or a year or 3 years, and looking for some of these private alternatives makes a lot of sense.
Yeah, I mean, it's really interesting when you just look at the average return of your retail investor against the indices, and they all fell, when the most trouble is happening, not
right.
The start of this year when the market was at 4,700. I think you're probably getting more phone calls now than you were at that point, just looking to review everything.
Well, for sure. And for the retail client, if you're buying Dogecoin and meme stocks last year, but you're selling Microsoft and Apple this year, you're doing it wrong. that's you have to play the whole greed and fear thing. So when last year was so frothy, that's the time that you need to start taking chips off the table and then redeploy them when it looks grim this year.
Yeah, and that's the biggest thing I want folks to take away from today is, while this year has been tough, the market does work in cycles, and we will rebound. The inflation will come down over time, even if it's just based on meeting the supply side. Demand, as we have the structure with the higher interest rates, will ultimately lower as well. So inflation will come down, and the market will rebound long term. So Deron, thanks for. You want to
No, it was a great point, and it was a great ending. Sorry to jump in here, but another great thing to remember is that we might get bad headlines in the next 6 months on the economy. The economy's slowing, but that in turn might be a good thing for stocks. Like you said, if you have a bad number on GDP, the economy is moving south, but that lowers demand, which then kind of matches up with prices and supply, which means inflation comes down, which means interest rates come down, and if interest rates come down, stocks might actually rally. And that's kind of what we're seeing this week. So this week might be a precursor to 2023.
Yeah, and with that point, folks, if any of you guys do have any questions for myself or Deron, certainly is a resource. We're able to access them as needed. So please let me know. We're glad to be that sounding board. Thanks for everyone joining today. And once again, Deron, thanks for taking the time to talk to us.
Great.
Appreciate it.
Thanks again. Talk to you guys soon.
Thank you.
Bye-bye.